You don't need to be a Wall Street genius to retire a millionaire. In fact, a staggering 90% of professional fund managers fail to beat the simple, powerful strategy I'm about to show you. This isn't about secrets, complex algorithms, or getting lucky with a hot stock tip. It's a low-stress plan built on a foundation of data, discipline, and time. It's about understanding why stock picking is a loser's game for most people. While individual stocks can create thrilling stories, broad market indexes quietly and consistently outperform, protecting you from the emotional whiplash that can destroy your returns. Think about it. An overwhelming majority of professional fund managers, people who dedicate their entire careers to this, fail to beat broad market indexes after fees. That's not my opinion. It's decades of evidence from independent scorecards that track performance. Over any 10 or 15-year period, the data is clear. The market itself, as a whole, wins. Real investing confidence doesn't come from a gut feeling or a talking head on TV. It comes from understanding how markets actually work over the long term. You don't need insider access or a crystal ball. You just need three things: broad ownership, incredibly low costs, and the patience to let the system work for you. Imagine owning a tiny piece of thousands of companies, all at once, with a single purchase. You get to share in the wins of tomorrow's innovators and benefit from the resilience of today's established giants. You're not just buying stocks. You're participating in the long-term growth of the entire American and global economy. The philosophy is simple. Don't bet on one horse. Own the entire race. Let's be honest, picking individual stocks is exciting. The hunt, the intellectual challenge, the dream of that one life-changing windfall. We all hear the incredible success stories and wonder, why can't that be me? But as investing legend Burton Malkiel warned, it's a game heavily stacked against the individual. To win, you have to be right twice. You must pick a great company, and you must pay the right price for its stock. A wonderful, innovative business can be a terrible investment if you overpay for it, and the future is fundamentally unknowable. Today's market leaders can be disrupted and replaced tomorrow. Unforeseen shocks, regulatory changes, supply chain disruptions, management scandals can hit a single company without warning. When you make concentrated bets, you're placing your financial fate in just a few hands. Worse, our own human psychology works against us. We tend to buy high out of a fear of missing out and sell low out of panic. The financial media machine amplifies this sense of urgency, encouraging constant churn. That emotional cycle of buying and selling destroys returns. Plus, every trade racks up costs and potential taxes that drag you down even further. Thankfully, there's a wonderfully simple, elegant, and proven alternative. It's called the 3-fund portfolio. The strategy is to own just 3 ultra-low-cost index funds, giving you diversified exposure to thousands of securities across the globe. You stop looking for the needle and simply buy the entire haystack. This allows you to balance aggressive growth with portfolio stability, letting you ride out any market cycle with confidence. The first fund is a total U.S. stock market index fund. This gives you ownership of virtually every publicly traded U.S. company, from the largest, most established giants to the smallest, most innovative startups. It's the engine of your portfolio's growth. The second is a total international stock index fund. This provides crucial geographic diversification, giving you a stake in thousands of companies across both developed and emerging markets outside the U.S. It protects you from single-country risk. And third, a total bond market index fund. This is your portfolio stabilizer. It holds high-quality government and corporate bonds. Historically, high-quality bonds have a low or even negative correlation to stocks. When stocks stumble, bonds tend to hold their value or even rise, giving you the stability to stay the course. So, how do you allocate? A common starting point for a long-term investor is 70% U.S. stocks, 20% international stocks, and 10% bonds. Younger investors might opt for more stocks, like a 90-10 stock-to-bond ratio, while those nearing retirement might increase their bond allocation to 30% or 40% for greater stability. Now let's talk about the magic that powers this strategy. Compound interest. It's often called the 8th wonder of the world for a reason. It's the process where your returns begin to earn their own returns, creating a snowball effect that grows exponentially over time. It is the quiet, relentless engine of wealth creation, and its fuel is patience. Let's say you start with just $500 this month, assuming a historical average annual return of 8%. After 1 year, you'd have $540. The next year, you earn a return on the full $540, not just your original $500. Your earnings start creating more earnings. Now, add the power of consistency. You invest $500 every single month. In the early years, your own contributions do most of the heavy lifting, but as time goes on, the compounding growth takes over. Eventually, you'll reach a tipping point where 1 year's investment growth can exceed your entire annual contribution of $6,000. After 30 years of this consistent approach, your $180,000 in total deposits could grow to roughly $750,000. That's the power of the plan. Knowing the plan is one thing, acting on it is everything. Here's how to execute. Step 1. Open an investment account. You can choose a standard brokerage account for maximum flexibility or an IRA for powerful retirement tax advantages. Look for trusted, low-cost providers like Vanguard, Fidelity, or Charles Schwab. The key is to find a platform that offers the low-cost index funds you need with a user-friendly interface. Pay close attention to the expense ratio of the funds, aim for as close to zero as possible. The online sign-up process is fast, usually taking about 15 minutes. You'll need to provide your social security number for tax purposes and link your bank account to fund your new investment account. If you're focused on retirement, consider a traditional IRA for a potential tax deduction now, or a Roth IRA for tax-free withdrawals in retirement. The most important step is to simply open the door and get started. Step 2. Automate everything. Set up automatic monthly buys into your 3-fund portfolio according to your chosen allocation. This is called dollar-cost averaging. It smooths out your average purchase price over time and completely removes the temptation to try and time the market. You put your wealth building on autopilot, freeing you to focus on living your life. Finally, remember that investing is a marathon, not a sprint. Markets will surge and they will sink. There will be crashes and corrections. Your greatest edge is not intelligence, but discipline. Avoid the temptation to panic sell during a downturn. Instead, stick to your plan. Rebalance your portfolio once or twice a year to bring your allocations back to their targets. This forces you to automatically buy low and sell high, a winning strategy driven by rules, not by impulse. This is how you build lasting wealth.